What is going on, everyone? Welcome back to another episode. I'm your host, Ryan Richards, a residential loan officer and real estate investor based out of Massachusetts and Rhode Island. I've got another solo episode coming to you today, filming this in the second week of April. And today we're talking about mortgage rates, which I'm sure a lot of you have seen the headlines. A lot is going on in the mortgage rate market. So we're going to pull back the curtain a little bit, talk about what we're seeing and how to best position yourself as a buyer in today's market, knowing that interest rates are probably going to fluctuate. So stay tuned and hope you enjoy the show. So as of today, the average 30-year fixed mortgage rate has hit just over 6.8%. Now, you hear that number, and depending on what news article you're seeing, you might think that is elevated, which, as I reference this number, a lot of what we track in the mortgage industry is averages. So this number I'm referencing, the survey is conducted by gathering rates from lenders across the country. So thousands of lenders input their rates to come up with this average. This represents the average interest rate on a 30-year fixed loan for a buyer who's purchasing a single-family home, primary residence, and putting at least 25% down with a strong credit score. So recently, a lot's been changing in the mortgage industry. And depending on what news you're seeing and where you're getting your sources from, you could see articles that suggest rates are a lot lower. And part of what happens is this. A lot of the reporting that goes out on news headlines and tracking mortgage rates is delayed. So depending on where they're getting their source data from, things can lag quite a bit. So it's really important that you're in communication with your lender if you're in the market today, which we'll get to. But mortgage rates have taken quite the wild ride in the last few weeks, which obviously if you own stocks, you're in the equities market, you've seen some similar volatility on that side as well. And a lot of times mortgage rates trade fairly similarly to stocks. They might not move the same direction that mortgage rates will based on a certain economic event, but they are volatile and reactive to economic data. So mortgage rates right now are primarily keyed in on the same three things we always have been. What's going on with inflation? What's going on with the recession fears in the market? How's that going to impact consumer decision making? And then the last part is global bond news. So that's one that we'll talk about a little bit. You probably haven't heard necessarily some of the inner workings of that piece, but it's very relevant today. And we'll talk a little bit about how mortgage rates are actually influenced. The primary influencing factor on rates is derived from what's going on in the bond market. So ultimately mortgages, 70% of the mortgages across the US that are written actually get bundled and sold on the secondary market. And large hedge funds, insurance companies, even like retirement accounts, 401ks, will buy what ultimately becomes a mortgage-backed security as a form of a debt instrument. They're investing in, you can invest in a T-bill, you're buying government treasury debt, and they're giving you a return for owning that debt to kind of free up some of their capital. It's very similar on the mortgage side of things. Investors, again, usually these are not your typical retail investors. These are large nationwide hedge fund type investors. They're buying these mortgage-backed securities as a form of a return on their investment. So depending on what's happening in the market, whether it's the economics or in the mortgage market specifically, it influences the cost and return of these investments. And that's ultimately derived from where investors are putting their money. So obviously things like inflation, recession fears, of course, tariffs impact where investors put their money. So that's part of the reason why mortgage rates are so volatile right now, is the news headlines that are coming out are fairly significant. We haven't talked about tariffs in a long time, and we haven't talked about potential recession fears, in many years prior to COVID. So we've got some big things moving around. Now, as these new data points come out, again, it's very reactionary. So that's why we're seeing such large swings in the mortgage market. If, let's say, for example, when Trump announced the potential tariffs, tariffs have a lot of implications on the economy, but one that's been very significant for mortgages is what's going to happen with inflation. If we're going to increase the cost of imported goods, typically that gets passed down to the consumer, which means prices go up. Whether it's you're buying retail goods for your apartment, you're buying new clothes, the cost of those imports, tariffs, typically trickle down to the consumer rather than the company just shrinking their profit margins. So that can cause inflation, right? If prices go up, that means we're in an inflationary time, and that's a concern for tariffs. So as a mortgage-backed security or bond investor, my thoughts on inflation change my decisions. For example, if I was going to buy a bond that was going to yield me 3.5% over the next 5, 10, or 15 years, depending on what I invest in, if I'm expecting interest rates to go up in that time as a result of inflation, well, now that return that I'm getting on that investment is actually lower when you account for the inflationary cost. So that can cause people to move, their money around. Investors adjust their investments, and that is, again, the fundamental of supply and demand. As investors take money out of the bond market, maybe they get more aggressive on equities, or right now, obviously, you're seeing a flight to gold and silver, some of those more quote-unquote recessionary-proof assets. The more or less money in a market dictates prices. It's the same thing here. So if investors decide, well, it looks like we're going to have some more inflation over the next couple months, I don't really want to be locked into a 3 and 3.5% return being invested in a bond or mortgage-backed security, so I'm going to go invest in these other assets. Well, in order to entice other investors, since there's less demand, they essentially reduce the price. And as that happens, that can drive mortgage rates higher. And we could get into all the inner workings as far as how that works, but on a fundamental level, inflationary concerns are not good for mortgage rates, which is obviously what put us in this position we are today. Raising the cost of funds to lower consumer spending and hopefully drive down prices. So why is that relevant for you? Well, I think it's important for a couple things. One, you just want to understand that mortgage rates are incredibly difficult to predict. So if your lender's telling you, I know what's going to happen in 6 months, or you can definitely refinance in the next 3 or 6 months, take that with a grain of salt. Because there's economists who spend their entire lives with PhDs and significant education and research who can't predict what's going to happen. So just understand that you need to be educated, at least on the base level, to be able to make informed decisions. There's a lot that's changing, a lot of good things happening, but you need to make sure you at least understand that nothing's set in stone. We don't know what's going to happen with mortgage rates, and mortgage rates can fluctuate day to day and even hour to hour like stocks and bonds. So if you're in the mortgage market, if you're in the home buying process, definitely make sure you're in communication with your loan officer. And not only what is the current interest rate today, but if you're going to look at houses this weekend, I have a lot of clients who reach out to me and say, hey, if my rate were to move 1/8 or 1/4%, what's the impact to my payment? Because sometimes over the weekend, rates can change when the market opens on Monday. So as they're making offers on houses, they like to know, if I make an offer on this house and my rate goes up, can I still afford it? But that starts with a preliminary education that I do with all of my clients in the beginning and explain mortgage rates can be volatile. Mortgage rates can go up 1/4%, down 1/4%. In this market, that's definitely common. So to those buyers, I like to have the conversation of making sure if your payment moved by $100, $200 a month, depending on your situation, could you still afford the home? And if the answer is yes, then great. Looks like you're shopping within the right budget. If the answer is no, and they're absolutely maxed out in their budget, I would probably recommend looking at a slightly lower price point. Because God forbid you get an offer accepted on the weekend and mortgage rates move like they did last week, you might be in a position where you can't afford to buy the home. And there might not be any way out of the contract. So just make sure you're having detailed communications with your loan officer and doing a little bit of homework, listening to podcasts like this to get a better understanding of what's going on in the market and how it impacts you. In terms of the future outlook, again, very difficult to predict. I think for a long time, everyone was under the impression that mortgage rates were going to come down and going to come down a lot sooner than they have. We've seen mortgage rates over the last 2 years settle as like a 7% average. There was definitely some times where rates were 8%, and there was some brief periods where rates were close to 6%. But we're not quite out of the woods yet. We need some more time for the market to settle down. We don't know the direction that tariffs are going. So I wouldn't necessarily bank on rates coming down anytime soon. I think we will get some reprieve. I think we will see rates take a slight dip once we iron out exactly what's going to happen with tariffs, and potentially if the impacts aren't as grave or significant as we thought, I think that would help mortgage rates. But my question, at the same token, is what's happening with inflation? A lot of the inflationary data that we're getting, for example, last month's report, doesn't include some of the impacts of these tariffs. There already had been some baseline tariffs put in place that I don't think the inflationary data necessarily reflects. So last month we had an awesome record low inflation number. Inflation actually went down. But I think as we start to pick up some of that trailing data, those numbers are going to start to change. So could mortgage rates go up in a couple of weeks? Sure. Could they go down as well? Absolutely. That's the hard part. So my overall outlook, I think over the next 12, 18, 24 months, we're going to see mortgage rates generally trend downward. But unfortunately, it's not going to be a smooth linear progression. We're going to have days where rates go up 0.25%, and we're going to have days where they come down 0.25%. So you just want to make sure, again, that you're putting yourself in a position as you're shopping, that you have a loan officer who's on your team, educating you and giving you the real information, not their best guess and opinion. And in the same token, you want to make sure that the payments you put yourself in on a house, you can actually afford, because you might not be able to refinance in the near term. It might not make sense. Rates might not come down. So I always tell my customers, make sure you put yourself in a position where worst case, you have a house you love and you're paying a payment you can afford. Best case, we'll refinance when the time comes. We'll lower your payment, put you in an even better position, but you can't guarantee that or bank on it. So just some things to think about. As always, if you have questions about the real estate market, what's going on in the mortgage market, overall just want to talk about real estate, feel free to reach out to me anytime and stay tuned for more episodes like this to come.